We don't. So really, we need to add that back because it's an expense, but it's really not affecting our cash. Okay? So there are going to be some items we're going to add back to come up with our the correct cash flow. And we're going to do the same with some of our accounts receivable and accounts payable so we can come back to cash. So as you see here, the current assets, not cash, but the other current assets and current liabilities, we're going to adjust from what it was at the beginning of the period to the end of the period, because that ultimately is money we're expecting to see. Some of that money's probably come in from the beginning of the period, but the money we show accounts receivable at the end of the period hasn't come in yet. So we're going to adjust our balance sheet. The investing activities shows the money's coming in and out as it relates to the investing activities of the company. Selling and purchasing property, plant, and equipment. And then the receipts from selling and paying for various investments. Sometimes companies will have excess money and they'll go and buy some short-term held securities or some investments so they can just make better money on their, better interest, a better return on their money. The financing section is going to be that section that shows everything related to buying and selling stocks and receiving long-term debt and paying back the long-term debt, along with paying out dividends. So the financing has to do with how do they support their growth, okay? As you see in this example, this is an indirect method financial cash flow statement. We start with net income. We always start our cash flow with the net income. From there, in the operating section, we're going to deal with adjustments for differences between income flows and cash flows. Depreciation expense and amortization expense is something we use to reduce our net income. But to find out where our cash really is, since that really wasn't a cash outlay. It was a cash outlay when we invested in that equipment years ago, okay? But for purposes of cash flows, we're going to add back those figures because it really wasn't a cash outlay here. We're also going to add back our bond discount amortization because we show the amortization from discounts, but it's really not an actual cash outlay. We also are going to show adjustments on certain assets. Think of this. If we had prepaid supplies at the beginning of the year of $700, and then our prepaid supplies at the end of the year is $300. We started the year with more prepaid supplies than we ended the year with, okay? So we used up some assets that we really didn't need cash for because we started the year with that prepaid. So even though it shows on our income statement as an expense, did we really use cash this year to pay for it? Do you get what I'm saying? Well, so we'll add that back. Increase in salaries payable. Think of this. At the beginning of the year, we had salaries payable of $300. At the end of the year, we have salaries payable of $1,000. Our expense shows salaries expense of $1,000. Did we really pay that with cash yet? So do you see how some of these items, it did affect our net income, but it really isn't affecting our cash. So we're trying to adjust these figures so we can come up with our right cash. Make sense?
So we're kind of reversing our accruals, sort of.
We're really taking our payables and some of our prepaids and receivables, and we're comparing the beginning period to the ending period and seeing if we need to add back cash or subtract cash, depending on what happened. Let's just think of our salaries payable a minute. Let's say it started with $1,000. Salaries payable at the beginning of the year started with $1,000. And then salaries payable at the end of the year is $300. At the beginning of the period, that salaries payable of $1,000 wasn't paid, but it did get paid this period. So we'd have to subtract $700 because that expense, that salaries payable, which ultimately was a salaries expense in the previous year, got paid this year. So if a payable is higher and then goes lower, we're going to have to subtract that cash. Because it was a payable at the beginning of the year, but guess what? We paid it in this year. So we used more cash than what we're showing as a net income. But if a payable starts the beginning of the year lower, and then at the end of the year it's higher, we'll add back cash. Because that higher amount was part of our net income, but we really didn't use cash yet. The next piece shows increase in income taxes payable. Again, give yourself a cheat sheet. Anytime from the beginning of the period to the end of the period, you have an increase in a payable, you're going to add back cash. If you have a decrease in a payable, you're going to subtract cash. Because that payable at the beginning of the period was really an expense in the previous year, but now we're paying it now. Do you see what I'm saying? So that uses up cash, but it affected the previous year's income statement. Next, we have things we need to subtract. Increase in accounts receivable. We're going to subtract that. Why? We started the period with $1,200 in accounts receivable. We ended the period with $3,000 in accounts receivable. Okay? So our income statement shows $3,000 of income. You know, because I'm saying that accounts receivable ultimately plays out to net income or sales revenues. Okay? So we show that in our net income higher, but have we gotten that money? We haven't gotten that money yet. So even though our net income shows it's higher, we're not going to get that cash till this next period. Okay? So in this case, we did get the money in from the previous period, but we haven't gotten that money in from what we show at the end of the period. So we're going to subtract out any increases in receivables. Increase in inventory, we're also going to subtract out. The decrease in accounts payable goes down, and a decrease in advances from customers is going to be reduced. So make a cheat sheet. Increases in accounts payable, you add. Increases in assets, you subtract. Decreases in accounts payable, you subtract. Decreases in assets, you add. Did I say something wrong? Increases in assets, you're going to subtract. Get a cheat sheet. Next, we go through the investment activities. Payment for the purchase of a building. So think of the purchase of a building. We use that money to purchase the building, right? We're going to subtract. Why? Is the purchase of the building in net income? No. It's an asset. All we're doing is depreciating the building. So we need to subtract what we spent to purchase that building. We also, payment for investment in bonds. We fork out money to invest in bonds. That's an asset. It shows up not on our income statement anywhere. Receipt from the sale of land. So when we received $5,000 from land, we're getting that land off our books. Now, there might be a gain from it, but the land we've got to add back as income. That's not really showing on our income statement. Only the gain aspect would be showing. Now, financing activities. When we pay out dividends, what happens to our cash? When we pay out the mortgage, why isn't the mortgage on our income statement, guys? It's a liability. The only part of that mortgage that's on our income statement is the expense we might pay on the mortgage and the taxes, and we depreciate the building or whatever that is, but the actual loan is just reducing our liability. Next, payment on a receipt from issuance of common stock. When we sell common stock, what does it affect? The equity section. Has nothing to do with income, does it? And so when we sell common stock, we're getting cash in. So that's why we need to show that aspect. So then we show the net cash provided by operating activities minus the net cash used in investing activities plus the net cash provided by financing activities. We've got a net increase in cash this year of $8,100. We show what we started the year with in the bank balance, and that should equal our ending bank balance. Does that make sense? Guys, I'll tell you, in accounting, for me, the most difficult aspect of accounting wasn't income tax, wasn't auditing, it was the cash flow statement. Really trying to take the time to understand, why am I adding, why am I subtracting? You know, a lot of times I just give myself a cheat sheet, but I never really thought through why. But if you can take the time to think through why, it makes total sense. A bigger payable this year, at the beginning of the period, was an expense. You got to write off that previous period, but you're paying it now. Make sense? The accounts payable at the end of the period is the expense you got. So you just have to think through what's happening to cash when I do these changes. Okay, so as we move on, there is an indirect method and a direct method. Why FASB encourages the direct method, I don't know, but we will deal with the indirect method, okay? The other thing I want to talk about relate to ratios. We will use various types of ratios to gain an understanding of the financial statements and to be able to compare them between one year to the next or one company to another. So we're going to look at one called the gross profit margin, the operating margin, and the net profit margin. The gross profit margin is basically taking your gross profit and dividing it by revenues. It's really letting us know the percent of that revenue that is our profit. Okay? The other way to look at it is the difference is the percent of our revenues that's in cost of goods. Our operating margin is going to be our operating income divided by total revenues. Makes sense? It's definitely going to be way smaller than gross profit, won't it? So if I ask you a question, which of these would be the lowest percent? Operating margin or gross profit margin? Operating. Gross profit only deals with cost of goods sold. Operating margin deals with all those other expenses related to the activity. Then we've got something called net profit margin. Net income as a percentage of total revenues. It's basically the profit per dollar of total revenues. So as you can see here, we've got a comparative financial statement here. Starbucks, we're showing the 2008